For the last several months, the prevailing fear among investors was straightforward. Runaway inflation was going to melt down the value of the dollar and destroy wealth across the board. But this week, the narrative flipped. Confidence rushed back into the U.S. economy, and trading floors lit up with renewed activity. The S&P 500, the Nasdaq, and the Dow Jones all closed noticeably higher. Technology companies drove the bulk of the gains, aided by surprisingly strong earnings reports from several major banks. Yet, if you walk down a grocery aisle or look at a rent bill, you won't see much cause for celebration. Average Americans are still absorbing the heavy impact of inflated everyday costs. It raises an immediate question. Is this sudden surge in stock prices the actual start of a new bull run, or just a temporary mirage covering up deeper economic problems? To see where the U.S. economy is actually headed, we have to look past the top-line numbers at the specific forces pulling Wall Street and Main Street in opposite directions. The latest U.S. inflation report shows consumer price increases dropping toward a 2% baseline. This downward trend acts as a mechanical relief valve. As inflation drops, pressure on the Federal Reserve to aggressively raise interest rates levels off. Investors are pouring money back into stocks right now because they anticipate the Federal Reserve will officially hit pause on making borrowing more expensive. Prices haven't fully returned to normal, but the mere expectation that interest rates will stabilize is enough to trigger a massive surge in market buying. The second pillar supporting this rally is the sheer endurance of corporate balance sheets. Large companies are reporting resilient earnings despite operating in a hostile economic environment. Silicon Valley and the broader technology sector took the lead here, pulling the major indices upward with outsized returns. Investors are celebrating a stark reality. These large corporations proved they can still generate massive profits, even when the cost to borrow money remains high. Combine the hope of stabilized interest rates with proof of corporate profitability, and the elusive soft landing, cooling the economy without a recession, suddenly looks achievable. But seasoned financial experts are actively refusing to celebrate the current rally. The most immediate threat to this delicate soft landing is the global energy market. Ongoing geopolitical tensions in the Middle East mean that oil production and pricing remain highly unpredictable. If energy supply is disrupted and oil prices spike, it acts as a tax on the supply chain, forcing the inflation curve back up. If inflation flares, the Fed must resume rate hikes. And as history shows, expensive borrowing crushes stock market valuations. This means Wall Street's current good mood is fragile, balancing on the razor's edge of global oil stability. This underlying fragility is exactly why institutional smart money ignores daily headlines and emotional market swings. Instead, they rely on a macroeconomic dashboard, a set of data points that help predict if the current corporate growth is sustainable. This dashboard tracks the Big Five: inflation, Federal Reserve decisions, corporate earnings, oil prices, and consumer spending. Tracking the relationship between these dials bridges the gap between Main Street and Wall Street. If high costs eventually cause consumer spending to break, the corporate profits currently driving the rally will likely follow suit. Navigating 2026 is about ignoring the noise and maintaining a patient long-term mindset based on these broader indicators rather than weekly headlines.